Right. Good morning and welcome, everybody. Thanks so much for joining us this morning. My name's Jo Simpson and I'm the Senior Development Manager for Eastside People. Before we begin, we've just got a couple of housekeeping points. We're going to be recording this webinar today and it will be available on the Eastside People website. We also will be sending it out to you, to everybody that's registered as well. And it's got a bit of a resource pack at the back, so it's useful for that too. We are going to use the Q&A today for questions, and we will be pausing a couple of times to take some questions and put those to our panel. So please do use the Q&A, and Marina's going to have a look at those and group them. Just before we begin and I introduce your panelists, I just wanted to provide a little bit of context. So social investment, I suppose, is nothing new. But it probably really ramped up about 20 years ago when there was a big injection of money from the cabinet and also the creation of things like Access, the Foundation for Social Investment, Better Society Capital, or Big Society Capital it was then, and Big Lottery Fund. And that started to create a really active market in this area. Indeed, it was seen sort of at the National Lottery Foundation did a study in 2012, and they basically looked at the marketplace and found that sort of the finance that was available was really unsuitable for the kind of finance and funding that organisations needed. And so a lot of activity has happened in this market ever since. And you've now got a whole range of sort of different providers and organisations that have benefited. Eastside People started around that time as well, about 20 years ago, and we provide a range of consultancy and recruitment services, including supporting organisations who are interested in social investment, helping them understand that what an option for them and apply for it. Just before we sort of move on, it was just in our work in that area, we basically realised that there was still, despite things like the Reach Fund, there was a lack of knowledge of this kind of finance, and also people were struggling still to understand how to access it and had many concerns about the risks involved. So it was with that in mind that we decided to host this webinar. So I'm just going to give you a little bit about our credentials, and then I'm going to introduce our excellent panel. Our consultants support social sector organisations to navigate this world. We've been working with programmes such as the Investment Contract Readiness Fund, Big Potential, and now utilise the Reach Fund to help organisations understand more about social investment and how it might play a role in their growth and development. We provide support with understanding the marketplace, considering the different investment options that are out there, accessing the Reach Fund, helping organisations to pull together the information they need to give confidence to lenders and ultimately to secure this type of finance. We help with fit-for-purpose business plans, with the financial forecasting and modelling, looking at good governance, and also with the social impact. We often recommend that charities and social enterprises... Oh, there we go. We often recommend that charities and social enterprises consider the Reach Fund, as this is a pot of money that is a grant funding that they can draw down to help them get some additional support from organisations like ourselves to help them prepare for social investment. That kind of money is available for organisations who perhaps lack capacity, knowledge or resource to be able to go about this work themselves. Since we've been involved in this area since 2017, we've done 51 Reach Fund projects. We've got 3 more in the pipeline at the moment, and we've helped organisations raise over 12.5 million. Right, I'm now going to introduce our panel. We've got an excellent panel today, and we're going to who represent many of the different facets of the social investment world. We will be hearing from Annie Constable from Good Finance, who's going to introduce her organisation and share an overview of the market. We've got Linda Wickstrom from Big Issue Invest, the leading social investor, Carolyn Sims from Charity Bank, one of the leading social banks, and finally we're delighted to have Darren Frost from Own Merit, who are going to talk to us about their own investment journey and accessing the Reach Fund. One last thing, before we sort of get underway with our panellists, I wanted just to sort of share with you this slide that helps us orientate ourselves a bit about what we're talking about. So this is the sort of the world of, I suppose, capital and finance. And we're going to be focusing on the areas to the left of the screen. So staying away from the traditional sort of commercial businesses, but focusing on the social purpose organisations. And you can see here those different types of social purpose organisations and the kind of funding that they might be able to access. Um, we're assuming that everybody's quite familiar with the kind of free finance, the grants type area. So we'll be focusing on the repayable finance area today. I just wanted to point out some of the things that are quite different about it. So this is often finance that could be drawn down and loaned, but often with an interest payment. It can be blended with a grant, so you might get blended finance as well. And what makes it different is that there is a consideration about the social impact or rather than just the financial return on this type of finance. Right. When I am talking to our panelists, I'll be particularly interested from Charity Bank and Big Issue Invest to understand perhaps where they see themselves on that slide and how that affects the way that they think about loaning finance. But first of all, we're going to hear from Annie, who's going to give us a bit of an overview of this marketplace and the kind of resources that are available. Thanks a lot, Annie.
Brill. Thanks so much, Joe, and good morning, everyone. Happy sunny Thursday. Lovely to see so many of you on the call this morning. Really, really great that so many people are interested and, dare I say, excited about learning more about social investment. So great to have you all here. As Joe said, I'm going to provide a very basic overview of social investment, what it is, how it works, and a little bit about good finance and how we help social enterprises and charities to navigate the space. So if we move on to the next slide, please. I appreciate everyone will be coming from kind of different knowledge points and understanding points. So please do bear with me if I'm kind of speaking about things that you already know about. But first of all, good finance. So who are we? Our mission is to help charities and social enterprises to navigate the world of social investment. We're a collaborative project, so we're jointly funded by Better Society Capital and Access, the Foundation for Social Investment. And our goal is to provide information, tools and resources, anything we can essentially to better equip users to build knowledge, make informed decisions and establish connections when exploring social investment. So I think what's really important to say here is I'm definitely not here to say social investment is the best thing since sliced bread and everyone should get it. We are independent, we are autonomous. What we really want to do is empower organisations to make the right choices for them on the future financing of their organisation. So if you find out that social investment isn't quite right for you during this process, that's absolutely fine for us as well, and hopefully saves you a bit of time, but it's something to keep in your back pocket for the future. In terms of our definition of social investment, so it is the use of repayable finance, as Joe said, to help an organisation to achieve its social purpose. So it sits alongside grants, donations, trading, revenue, any other kind of income streams you may have, to help a charity or social enterprise to generate a surplus or a profit. And it's that profit or surplus that is then used to repay investors who have provided some capital for your organisation. If we go to the next one, and again, brilliant, thank you. So we always like to say that social investment sits alongside a range of different kind of revenue streams, such as donations, trading, contracts or payments by results, banks, whether they be social or mainstream kind of loan format, and grants as another tool that you can use to create impact. So really important to think of it as not the be all or end all, not the one thing that's going to kind of save your organization, but part of a wider financial toolkit that can help you to achieve your organizational aims, both socially and financially, moving forward. And as it says there, you can use a combination of all or some of these tools, depending on your business model, legal structure, etc. Before you kind of get stuck in, as I like to say, with social investment, there are some kind of key considerations to think about. So the first one is purpose. What do you need that social investment for? You know, we always say to charities and social enterprises, you know, make sure you have a really clear idea in your head on what you need the money for and how it's going to make a difference for the communities you serve. So the typical kind of reasons for getting social investment that we see include buying an asset, kickstarting a new venture, growing and innovating their business, and maintaining cash flow. Lots of others are available, but those are the kind of four key groups that we see quite a lot of use cases for social investment. Once you're clear in your head about the purpose of seeking this type of finance, the second consideration is repayment. As we said, it's not a grant, it is money that you have to pay back, usually with interest. So, do you have a profitable income stream to be able to afford those repayments? As I said, that can look like anything really: contracts, rental income, membership fees. Some social investors will even take into account kind of donations and grants. And then there's also trading as well. So, how much money are you making, and can you actually afford to take on this type of finance? Or, crucially, will you be able to? And the final consideration we have here is impact. So that's what really sets this aside from kind of more mainstream forms of finance. What difference is that money going to make for the communities that you serve? So what are the activities and outcomes that can happen as a result of this injection of capital? Who's really going to benefit? And how are you going to measure and report the success of that social investment to your stakeholders, including your social investors, but also your end users, your customers, anyone else that might want to be part of that wider mission? One kind of stat that we like to share here as well is that actually we have a directory that lists over 120 kind of social investors and funds, and 85% of those social investors are in fact charities or social enterprises themselves. So, you know, a lot of the time we say they get it, they're going through a lot of the same challenges that you are actually, and they're on your side. So, really important to remember that as well. So going back to the very, very basics of social investment. So there's two main kind of types: debt, which is when an organization borrows money and pays it back, usually with interest over a set period of time, so the duration of the loan. And then there's also equity, and that's when an organization sells shares to an investor, and they then own a percentage of the organization. And within these two kind of broad main types, there's lots and lots of different types, all of which are listed on the Good Finance website if anyone wants to dive a little deeper into some of those. There's also kind of two main providers of social investment. So we've got an organisation that might be a specialist social investment firm, and I know we'll be hearing from Big Issue soon. It could be a social bank, and conveniently we'll be hearing from Charity Bank very soon. Or it might be a trust or foundation that are looking to repurpose their finance and loan you some money. It could also be an individual. So that might look a little bit more like crowdfunding, community shares, angel investors on a mass reach level, reaching lots and lots of different people. And which type kind of works for you and where that money comes from really does depend on a whole myriad of factors, which means it's really important to do your homework and find out which type of money is best suited for your organisation while you explore the process. Brilliant. And one question we get quite a lot is kind of what makes a social investor social? And that's completely fair enough. So we like to look at it as a bit of a scale, really. So towards the right-hand side, you've got traditional investment, financial return. These are the kind of mainstream financial institutions. They want their money back, and they want it back with interest, and they're not really bothered what else you do with that capital. To the left-hand side, you've got more philanthropic organisations. All they care about is social return. So that might look like a grant. They're willing to give you that capital, but they do need to see social outcomes as a result of the money that they're lending your or that they're giving to your organisation. Social investment sits somewhere in the middle, and where on the scale a social investor sits might depend on where their money comes from. Some will be slightly further to the right, and some will be slightly further to the left. But the real difference is they really care about what difference that money is going to make for the communities that you serve, while still wanting to recycle their capital, so that they can then lend again to organisations like yours in the future. Go to the next one. We often also get asked, what does a typical process look like? And I will caveat that we can't speak for every investor, but typically you will kind of, when you approach an investor, you will go through what's called pre-due diligence checks. And that's just to make sure, you are aligned with the investor, they're aligned with your idea. It is kind of in their eyes something to pursue and explore, and, there's some kind of synergy between your organizations before going into the due diligence process, which typically takes a bit bit longer, quite a bit of paperwork. We've not found anyone that enjoys it, bar one lady in Nottingham who absolutely loved it. But yeah, that's quite a kind of arduous process as you kind of go through and get everything ready that the investor needs to be able to lend you that capital. You then get a decision usually at an investment committee. And following that decision, if it is a positive outcome, you will then go into structuring and documentation, which is where all the fun with lawyers and solicitors come into it, before finally being able to draw down that capital, and then ongoing monitoring, which for some investors might look like kind of monthly reports. For others, it might just be a kind of fortnightly coffee over Zoom. It really does depend on the investor and your relationship with them. But that's typically what the journey can look like for social investment. And then just a little bit about Good Finance, so who we are and what we do. As I said at the beginning, we are co-funded by BSc and Access. So everything on our website is available for absolutely anyone. It's all free. And I really encourage everyone to go and take a look at some of our tools and resources, all the way from kind of, is it right for us? That gives you a quick answer on whether or not social investment is right for your organization, to the investor directory, which, as I said, lists over 100 investors, and you can use the filters to make sure that you're kind of matching with investors that are aligned with your organization. We've also got a jargon buster. There's lots and lots of jargon, acronyms, buzzwords in social investment. We've designed this tool to hopefully make it a little bit easier whilst you're trying to navigate the space. And understandably, we get a lot of questions about cost of capital. So working out exactly how much a loan will cost your organisation. We have a calculator that will give an estimate of both the monthly breakdown of costs, but also the total cost of social investment to your organisation. So well worth checking out those. And we also have a range of case studies, blogs, videos, events, hear from a peer stories, etc., that will really help you to dive into the process and understand more about how it works. And I won't go through all of these, but I will just say we have an amazing suite of e-learning programs that are available again online for anyone who's interested. You know, maybe these couple of slides have lit the fire of passion within you and you simply must learn more about social investment. Really recommend taking a look at some of these e-learning courses. As I said, available to anyone, and they'll really help you to kind of guide you with those next steps into the world as well. And I think this is my final slide, and I'm conscious of time, so I will whiz through it. But I guess some key kind of lessons that we've learned from those slides. Then, so social investment is not benevolent money. You know, it can often get confused with grant. It's not. It is money that you have to pay back with interest, and it's important to bear that in mind while you're exploring the process. Impact matters. It's not just about the money for social investors. They really care about your mission and the difference that you're going to make in the world. And so treat them as a partner. Keep that in mind, and remember that you probably have more in common than you may think. It's about much more than just the money. A lot of investors are able to perhaps signpost you to the Reach Fund, which I'm sure we'll hear more about later. They might be able to provide wraparound support, or if it's not something that they can invest in, they might know someone who would be interested and kind of make that introduction for you there as well. So really key to work with them rather than against them, and see them as that kind of helping hand while you're looking kind of navigating what is quite a complex process. Honesty is always the best policy. Social investors are not monsters. And, you know, once you've kind of gone into that partnership, they understand that things go wrong and that's not always in your control. It's always better to pick up the phone and tell them sooner rather than later if you've got any concerns or worries about, you know, what happens if it goes wrong or if I can't make repayments. Actually, a lot of the time, social investors are able to be a lot more flexible than mainstream providers. So do keep that in mind. Why isn't it cheaper if it's social? A question we get quite a lot, and obviously a range of different rates are provided by lots of different social investors, and it really does come down to where that money comes from. A lot of the time, investors might be borrowing it themselves, and they will be expected to pay that back with interest themselves. So it's really about making sure that capital is recycled and reused again and again to keep social enterprises and charities like yours in the earlier stages, kind of keep those opportunities open for them. Due diligence isn't fun, but it does make your business better. As I said, we've not really met many people that enjoyed that part of the process, and it can feel quite personal. But most of the people that we speak to feel a lot more confident about the future financing of their organisation moving forward once they've been through that due diligence process. And finally, it always takes longer than you think. We do get questions a lot like, oh, I need to buy this building, but it has to be bought within kind of 6 weeks. Can I look at social investment and what are the time frames? My kind of go-to is never say never, and I'm sure an investor will make it work if they can, but it's highly unlikely to turn around very quickly. That ICs, for example, investment committees might meet kind of once a month or once every 6 weeks, which means automatically it's going to take a little bit longer than you might need. And it's always worth exploring before you think you need it, so you can approach the process prepared, and understand that it might take that little bit longer than you were perhaps hoping. I think that's my final slide. I'm hoping it is.
Yes, thanks so much, Annie. That was really, really informative. And just to echo that point, as those that are involved with the kind of supporting people through the due diligence, it either goes quite smoothly and whizzes through in a reasonable time frame, or else it really stagnates and takes a long time. So that's great. Just also to say before we move on that we'll be sharing links to the social finance website, good finance website, sorry, and also to Annie's contact details so that you will be able to get in touch and access all the resources she's talked about. Thanks so much. Okay, let's now move on to Linda. So thanks, Linda. Welcome to the session. And I wonder if you can just tell us a little bit about Big Issue Invest and where you perhaps sit on the spectrum and how that affects the way that you lend and your position in the market.
Yeah, absolutely. So, good morning, everyone. It is so lovely to be here. Thank you for having me. So, I'm an investment manager at Big Issue Invest. I've been here for nearly about 3.5 years. So, my job day to day is really to look at investment applications. I look mainly at loan finance applications up to about £200,000. But we do a whole range of funding types. Maybe next slide, please. So just to tell you a little bit more about Big Issue Invest, we are part of the Big Issue group. I'm sure many of you have heard of Big Issue. We also sell the magazine and work a lot with vendors. But I specifically work on the invest side, and we've been going for 20 years on the invest side. So since then, we've kind of deployed over £100 million. So we were one of the first in the marketplace. As it says here, we're absolutely an impact first investors. So we will only really invest in organizations that have a specific social mission. And a lot of our investments also go to the most deprived areas or organizations that are based in those areas. And as explained previously, we do balance kind of impact with financial returns. One thing that I guess, again, sets us apart from more traditional sort of mainstream funders is it's really high tailored support. So we will never use kind of computers or algorithms or anything like that to determine whether your organization can be funded. We're forecast led, so we will look at, your forecasts, where you're heading. We will not look at a net asset number and sort of just say whether you can afford this funding or not based on that. It's really highly tailored, and you'll be allocated investment manager from day one to kind of work with you. And we try to sort of work with you to peel back an onion almost layer by layer, where we really want to make sure that, we do an initial kind of chat with you. And if we think at that point it's worth kind of taking things further, we kind of ask for more information as we go. We also really try and push for social equality. So looking at, social enterprises owned and I guess working towards equality goals and owned by people from global majority and so on. We have a specific fund called the Growth Impact Fund that specifically addresses this, but we do that across all of our various types of funding. Move on to the next slide, please. So just to give you a little bit of context about our funding and where it comes from, Annie mentioned, it sort of depends, so investor to investor, who kind of our risk tolerance and the types of kind of money we can provide. So unlike a bank, our money does not come from, I guess, deposits that bank account users would deposit. Our money comes from a real mix of so we've got Access Foundation, which is they use sort of government money so concessionary capital. We have a mix of, we also have corporate funding, where corporates who are looking for a kind of social return. And we work with trusts and foundations, as well as some more commercial capital, so to try and leverage in and build scale as much as we can. But it means that we are fairly risk tolerant, especially in comparison to commercial providers. As I said, we're forecast led, so it's all about looking at how much you can afford to repay. We have quite a kind of different number of types of programs. So we fund from fairly early stage through to kind of organizations that are more established and trying to grow. I should say we tend to look for at least 2 years of track record across all of our programs. So we're not here to start kind of with the very, very early startups. And that is because usually your repayments will start. We will often be able to provide kind of interest only periods and things like that, but then there is usually a regular repayment, which means that income streams should be fairly stable, and so that you can then repay the capital. But we fund a whole range of different things, from growth, asset purchase. We do secured and unsecured. We have funds of up to 3.5 million. So for kind of those asset-based kind of purchases, but also really small funds of about 20,000, where you might just need an unsecured loan for something. We also support kind of cash flow. It might be contracts that need cash flowing, etc. So a real variety of things. And if you go to the next slide, Joe, I'll talk about that in a little bit more detail. So we have loans and we have kind of equity and revenue share investments. So if we start on the loan side, we do, as I said, loans from as little as about 20,000 up to 3.5 million. And that is, with interest. The interest slightly depends a little bit, but we try and keep interest fixed so that you know what you're repaying rather than variable, with base rate. And it makes it easier for you to plan what you're repaying. Loan periods tend to be up to about 5 years. So unlike a bank, we cannot kind of stretch to really long mortgage type loans, but what we can do sometimes is amortize over a much longer period. And then when you get to the 5-year mark, you will then refinance either with another fund that we have, or move on to perhaps a bank if what you're requiring is I guess a much longer term loan. But often what we do is we support, for example, if someone is buying a property and the bank will only fund you up to maybe 65% loan to value, we can also work with bank, provide that deposit if you don't have that already, and take a second charge on a property. We can also be a standalone funder and work with you to do that. So it's a real kind of variety of loan funding that we're able to do. We have something called Debt Fund 4, which is a fund which actually provides up to 90% loan to value, and is designed to be kind of a fund that allows you, rather than having to do a piecemeal kind of fundraise where you're trying to get money from lots of different pots, we are there to help you take that early stage kind of I guess that tricky period in the first 5 years when you're trying to get everything together, and then maybe move on to a kind of bank from there on after the first 5 years. So then we have equity and share. Sorry, just to very quickly mention equity and share, if we go back one, we, through what we call the Growth Impact Fund, which is our fund that really focuses on equality and equity. We provide equity and revenue share investments. So that's, as Annie explained, is where we usually take shares or revenue shares for companies that don't have share capital, but that want a sort of equity style investment. I should mention that equity investments are on pause until next year, but we are doing revenue share investments currently. So if you're interested in that, just it'd be great to hear from you. Next slide. Yeah, great. So Annie did cover some of this already, so I won't go into too much depth on this, but yes, we have a very similar process to what Annie outlined. We do a kind of screening where we try and kind of figure out first if you're a good fit. So we won't ask for too much information up front. It's not like you're kind of providing or filling in a massive long application form and then just get a straight no. We will usually just ask for a meeting with some basic financial information from you up front. And then if we think that is suitable, you'll then be asked to kind of go into the due diligence process. And we try and tailor the due diligence process according to the size and kind of risk profile of your loan. So if you're asking for a 20k loan, we're not going to ask you for the same amount of information as a £3 million loan. And we do have access to the REACH fund, which is the pre-investment readiness fund. We also actually, for our equity and revenue share participation, have our own in-house kind of technical assistance fund, which allows you to, is very similar to the REACH fund and giving you kind of that pre-investment support to build up the kind of information that you need to go through the due diligence. And then post-investment, exactly as kind of Annie outlined, we're patient. We are here to help you. We want to talk to you if things change. Things may not always go as planned, and we are here to work with you on this. We're absolutely here to kind of help, and we want to hear from you. And then I think, yes, just a very final slide. Just to kind of touch on our impact, last year, this is our impact from 24-25. We worked, with over, with nearly 2 million, impacted nearly 2 million people through our investees last year. We worked with 139 social purpose organisations. So, and as you can see, there's a whole variety of the kinds of things that our investees do, and kind of touching across a whole range of the kind of SDGs. So please do get in touch. We would love to hear from you.
Thanks so much, Linda. That was also super informative and really helpful to understand a bit about the process as well, and actually where the money comes from. And just to remind everybody, we'll be sharing this pack, so you will get Linda's contact details as well if you're interested in the funds that Big Issue Invest offer. Right, we're now going to move on to Carolyn, who's our sort of final panelist from the social investment side, and then we'll have a little pause for Q&A. Click. There we go. Lovely. So I'd just like to welcome Carolyn Sims, who's the Director of Impact Lending from Charity Bank. And perhaps Carolyn can talk to us about Charity Bank and what they offer, but also perhaps how they are different to the way that Big Issue Invest operate. Over to you, Carolyn.
Thank you, Jo, and good morning, everybody. Could you move on the slide, please? So, I'm sorry, just go back one, Jo. That's it. So my name is Carolyn Sims. I'm the Director of Impact Lending at Charity Bank. I've worked for Charity Bank now for 20 plus years. I'm also fully embedded in the sector. I act as a trustee of a number of social sector organisations, and I chair the Postcode Lotteries Innovation Trust, which is a blend of grant loan mix. But I'm talking about Charity Bank today. Next slide, please, Jo. So a bit about Charity Bank. We were set up to support charitable organisations who needed to borrow, but who couldn't borrow elsewhere, or they could borrow, but we felt the terms to be unfair or unaffordable. We're a very simplistic and old-fashioned banking model. We take savings from people, so that's individuals, trusts, foundations, corporates, SMEs, and then we lend that money out, but we only lend where there's social impact. And what I would stress here is, although our name may be Charity Bank, we lend far wider than just to charities. So what motivates us is about impact. We are less hung up on the legal format that is delivering the impact. It is all about the end result. So it's about the benefits that you have to your local communities or to disadvantaged people. So we will lend to some full-for-profit organisations where we believe they are delivering very impactful work. And we protect our mission either by an asset lock or by dividend distribution cap, or if you've got a full-fledged private sector organisation that's maybe leasing a property to a social operator, we will tie the term of our loan into the term of the lease with the social operator so that we ensure that we lock the impact in. Our vision is for a society that fosters vibrant communities and a healthy planet. This motivates and drives what we do. In all of our time of being, we've made over 1,400 loans worth nearly £600 million, and that's since our inception in 2002. And we are 100% owned by charities and social purpose investors, and I'll come on to talk a bit more about those later. Next slide, please, Jo. So sorry, and I must apologise, I've noticed a typo in this. We are a regulated and fully authorised bank, but we are no longer a registered charity. We were a registered charity until about 2014, but we gave up our charitable status. And I think it's fair to say that we are effectively a social enterprise now. I've already touched on the fact that we lend to charities and social enterprises. We use the deposits that we take to make those loans. And because we're using depositors' money, we can lend longer term than people like Big Issue Invest. And I'll come on and talk about our loan terms. We tailor what we do to charities and social enterprises' needs. So we don't have bespoke lending products. We talk to people, we understand what it is they're trying to do, and then we try and tailor something that best meets their needs. Next slide, please, Jo. So why use loan finance? It can be for a wide variety of reasons. I think it's fair to say that most of our borrowers borrow money from us because they want to buy, develop or refurbish a building. Quite often we work with organisations that are renting their buildings, and they frequently find that actually it's cheaper to buy their building than it is to pay rent, and they may well buy the building they're operating from. Or sometimes they have a building that they own that just needs some refurbishment, or it may be that they want to extend that building so they can expand the services that they offer. We also quite frequently refinance other borrowing. It may be that you want to buy a building in a real hurry. Quite often we come across social sector organisations that have taken out bridging finance to buy a building in a hurry. That can be quite expensive, and so we will then refinance that borrowing. It can be to bridge the receipt of delayed funds. It may be you've got a promise of money. It may be that you have pledges, but that money is going to come in over a period of time. And in the meantime, you've got the need to use that cash. It can be to support working capital, or it can be to invest in new activities and develop new income streams. Many of the organisations we work with are trying to remove themselves, from dependency on grant funding. And so they're trying to develop new income streams where they're actually generating their own income and therefore to a certain extent in control of their futures. And so we help fund the work that they do. It's quite frequently the funding that we make is to provide match funding for a package of funding. So it may be that you've got one or two grant providers. They quite often say that they'll only fund up to 50% of project costs and that you have to raise the money elsewhere. We quite often are that other elsewhere pot. And it can be to supplement grants and donations. What we don't tend to do is replace pure grant. If you've had grant funding to date and that grant funding has stopped and you desperately need some cash, that doesn't tend to be the type of thing we do. Next slide, please, Jo. So what we look for. So the first thing we will ask any organisation that we talk to is around the social impact. What good do you deliver? What type of communities are you working with? What sort of beneficiaries are you helping? And we want to see evidence of demand for your services. If you're looking to expand your services or develop new services, then we would want to ensure that you've done sufficient market testing to make sure that there is going to be continuing demand. And sometimes this is where we work closely with Eastside People. It may be that we can get you a REACH grant to help you do a bit of market testing, just to ensure that there is going to be demand. We're looking for well-developed and well-thought-out plans. We also want to see timely and accurate financial accounts. If you're a registered charity, we will check the Charity Commission website to make sure you filed your accounts in a timely fashion. We accept that there can be hiccups from time to time, but we would need to understand why. I mean, a case in point is COVID, where many organisations were late in filing their accounts. But it is something that we look for. And we also obviously want to see evidence of affordability. The last thing we want to do is to get any organisation into a position of stress where they take on debt finance and they cannot afford to meet the loan repayments. We're also looking for good governance. We look at the quality of the directors or trustees. We want to make sure that you've got a broad range of skills and that are relevant to the type of organisation that you are, the types of services that you're providing. So we would look for someone with financial experience, ideally with HR experience. If you're a housing organisation, we want to see someone with housing experience. It's that sort of thing. We will also ask about the security you can provide for the loan. It's fair to say that the vast majority of charity banks borrowers are secured borrowers, so that, in other words, they can provide buildings as security for the loan. We do, however, have a small unsecured loan programme called our LEAP programme, which is something we're very proud about. It provides very impactful loans, and probably about half of the loans we make through our LEAP programme are unsecured. We quite often come across really interesting community organisations that are delivering really impactful facilities within their local communities, but they may be operating from a leasehold property. And quite often the leases are too short for us to take them as security, but we want to support them, and we can do this through our LEAP programme. We'll also look to see whether you've got an internal risk assessment or register. We need to understand that our borrowers do understand the risks they're facing and have thought about mitigating actions. And as I said already, we're looking for significant tangible social impact. Next slide, please, Jo. What I thought I'd touch on is the questions, if you're thinking about borrowing money, the questions that actually you should ask your lender. It isn't just about lenders asking you questions, you should also ask. And I think the first question we're always asked is, what's the rate going to be? How much is it going to cost me? So this is something you need to understand: the rate, the type, and the term. How long are your loan repayments going to be over? What type of interest are you being charged? Some of the social lenders will provide fixed rate interest for the period of the loan. Most frequently, you'll probably be quoted a margin over Bank of England base rate, and that is what we call a variable rate. So it can go up and down as the Bank of England interest rate changes. So you just need to understand what type of interest you're going to be charged. You need to ask about fees. There will always be an arrangement fee, but you need to understand what other costs they're going to be. With most lenders, you are liable for valuation costs and for legal costs. So you just need to get a good idea so it's not a shock. Security, you need to understand whether you're going to be expected to provide security, and if so, what is required. And also commitment. When do you become obligated to the bank or the social impact lender? So most lenders have information requirements, so you'll be required to provide. So understand the time at which you are then committed to provide that information to them. Another thing that's really important to ask and to understand is default. What happens if things go wrong? You just need to understand what can trigger an event of default, and then what happens if you do find yourself in a default situation. We've already heard this morning about how social impact lenders tend to be more benign when it comes to default situations, and I think that's a really valid point. In all of the time of Charity Bank's period of operation, we've only written off less than 0.5%. And in fact, we've only enforced our security in 2 times. And that is where the borrowers effectively walked away. They wouldn't respond to emails, phone calls, and our security was being vandalised overnight. And we had no choice but to step in and try and protect our security. But borrowing through social lenders, they will work with you if you get into difficulty. They will try and support you. They will try and find solutions. You also need to understand what loan covenants are in your loan agreements. So most social lenders will have some form of covenants. These are tests that you probably need to meet on a quarterly or annual basis, and they're probably around your ability to meet your loan repayments, so debt servicing covenants. But you need to understand what these covenants are, and you need to make sure that you think you can meet them. If you don't feel you're going to be able to meet them on an ongoing basis, then talk to the lender. They're not written in stone. They're there to be set at a level that you think you can meet. So don't be afraid of questioning these. Next slide, please, Joe. What else you should ask or look for from your lender? A fast and efficient process. I did quickly look in the questions chat, and someone asked about how quickly they think from expression of interest to actually drawing a loan. We have seen borrowers draw a loan in 8 weeks. That's quite short. We would tend to say probably 3 to 4 months. And if it's a complicated loan or a complicated structure or complicated security, then it can take longer than that. So it's always better to start the conversation early. I touched on the bit about costs. You need to ask at the outset what the process is and what costs you're going to be obligated to pay. Ask about social sector expertise. A lot of social sector lenders have specific expertise within the teams, so try and find out about that. You should ensure that they have a supportive approach, and it's worth probably talking to other organisations that have borrowed from them in the past. About 65% of all of our new loan inquiries come as a result of recommendations from people who have already borrowed from us. So that's a really good indicative sign. And it's more than about money. It is about ethics, value, and status. So understand what the lender is trying to do. Are they supportive? Are they completely embedded within the sector? Next slide, please, Joe. I said I'd come back to the ownership of charity banks. So if you can see the slide on the right, it's a really good example of the types of organisations that invest in charity bank. So Better Society Capital is our largest shareholder, but then we have a whole raft of other names that are probably familiar to you, people like Tudor Trust, Esme Fairburn, Lankelly Chase. A number of the livery companies also invest, in fact, they also borrow from charity bank, but they invest in charity bank. And one of our more recent shareholders is the Church of England, who really values the work that we do with the faith sector. Next slide, please, Joe.
Right, that should be back. Sorry about that. Are we in the right place?
No, we need to jump forward. I think 2 slides.
Here we go. Hang on there. It's just getting there. Apologies for this. That's not moving, is it? Great. Sorry about the technology.
Well, I'll talk to my
slides.
To
the slides, yeah. I'm not quite sure how we
let me just go down.
Sort this out. Why this one isn't moving.
Okay. So what I also wanted to just touch on is the types of loans that we make in the sectors that we lend in. So our largest lending sector is the housing sector, the social housing sector. So we have lent about 260 million into this space, and that's social housing in the widest meaning. So it's registered providers, it's community land trusts, charities who support people who've perhaps come out of prison or where people have been subject to domestic violence. It's almshouses, it's abbey fields, YMCAs. And then that's fairly closely followed by health and social care and faith. We do a lot of work in the faith sector. I just need to read my screen. We've lent more than 100 million and made over 200 loans to faith-based organisations. But if you are a faith-based organisation, what we are looking for is your engagement within the wider community. We don't lend for faith per se. We want to lend to organisations that are supporting their local communities. And then the impact of our loan. This is something I think that's really important to focus on. So we regularly go out to our borrowers and we do surveys, and 96% of our borrowers have said that a loan from charity bank has positively supported their mission. 83% of them have said that it's led to growth in their assets or facilities. 82% said it strengthened the organisation, increasing their likelihood of growth. 78% said that the loan improved the quality of the services or facilities. 72% said it led to growth in services offered. 66% said it helped resilience during economic crisis. And 57% said their project would not have gone ahead without a loan. So that's a really good example about the benefit that taking a loan can have on an organisation. We operate a team of regional managers across the UK. So there's always going to be people sort of based fairly close to where you operate. Not surprisingly, the largest area of our lending is in London and the South East. This is obviously where asset values are at their highest. And then the other thing I think just to touch on, we also take savings from charitable sector organisations. All savings that we take up to £85,000 are covered by the Financial Services Compensation Scheme. And I would just say that by saving with Charity Bank, you're then enabling us to make loans to organisations similar to yourselves. And I'll stop there, Jo. Thank you.
Brilliant. Thank you so much. And thank you. We're at the point of some questions. So Marina has been monitoring the Q&A and is going to group the questions. Just to sort of say that any questions that we have, we're going to read out on here so that we obviously get them on the recording, and then those that are watching out after the session can obviously hear the question and then see the answer from the panel. Marina, over to you.
Right. Hello, everyone. Can you say some of the questions I think have been answered? So there were some questions about charges and motivations, why social investors provide social investment, and there was a question about new builds. So I think they've been answered by presenters, and the timeline, I think that one was also answered by Carolyn. What are the types of causes that social investors might be particularly attracted to? I don't know who wants to.
Should we start with Linda on that one? Because I think with Big Issue Investors, they've got a particular sort of areas of interest.
I'm sorry, what is the question?
It was about, are there any particular types or causes of people or groups that social investors might be particularly attracted to?
It depends. Big Issue Invest is quite agnostic when it comes to social impact. The funds that I work on will pretty much, look at any type of social impact. We will usually balance depth of impact with the risk we're willing to take. So if you're a organization that works with ex-offenders and housing them when they come out of prison and rehabilitating them, and that's really high depth, really high impact work, and we're then willing to take a higher risk. But if you're an organization that's more kind of, you might be information based, you might be providing information on a very light touch basis to a larger amount of people, something like that, we might take less of a risk. It's sort of, but it depends. Lots of social investors they sometimes have specific geographical patches that they look after. Sometimes they specialize in particular sector verticals. You'll, I think, particularly find that with more venture-based finance, for example, when it comes to equity, and they want to understand the sector more. But for us, we will look at pretty much any kind of social impact, unless it's very purely environmental. But that said, we will look at community energy schemes and lots of things like that as well, because it has a social impact. But yeah.
That's great. Thank you very much, Linda. Probably same question for you, Carolyn.
Yeah, I think for us, it is social impact first and foremost. Currently, we are particularly focusing on energy efficiency. We have had an energy efficiency loan programme, a blend of grant and loan mix for organisations that want to make their buildings more energy efficient. Unfortunately, we deployed all of those monies. We're hoping to have some further funds to lend next year. When I say funds, we will always lend to help organisations make their buildings more energy efficient, but we're trying to do it with grant as well. We're also at the moment particularly focused on the children's space. There is a lot of work going on in the background with government about ensuring that children who are taken into care have better outcomes. And we are particularly keen to fund some of the disruptors that are proving that actually there are better ways of providing homes for children who have been taken into care. So that's a particular area of interest for us. I think also it's probably important to mention the types of things that we won't fund. So, and apologies if anyone is from this background on this webinar, but we don't tend to fund private schools. They may be registered charities, but with most of the private schools, we feel that the impact they're delivering just isn't sufficient. There are some very good private schools that do deliver at high levels of social impact, and they engage with their local communities, but the vast majority of private schools just unfortunately don't tick that box for us.
Brilliant. Okay, thanks so much. Marina, are there any other
Yeah,
questions?
there's another question that's just come in on the similar topic, which is about, does anyone offer VSLAs, which I think is Village Savings and Loan Association loans for international development charities?
Linda?
Yeah, so maybe that's one thing that is mainly our I guess restriction is that impact should be in the UK. Some of our loans are restricted to England, but others are kind of UK wide. If you are an international kind of aid organization, and your impact is mainly outside of the UK, that's not usually something that we fund. And that's because a lot of the money that we have is kind of money from the UK government, and they want to see the impact within the UK.
Yeah, Carolyn?
I don't think we're dissimilar, actually. When we look at organisations, we do look to see how much of their funding is going overseas. And I think if it was more than about 25%, it would cause us problems.
Cool. And I was just going to mention the Reach Fund, which we've talked about a few times as the kind of enabler grant fund to help people get themselves ready for social investment. And that is an England only fund. And again, has some similar other kind of eligibility criteria to those that Carolyn and Linda have mentioned, around 2 years and having 2 directors and that sort of 2-year track record. Annie, do you know of any international development funds? Just thinking about your ability to kind of cast your eyes across the sort of wider environment.
Unfortunately, because we're funded by BSc and Access, we are also UK only. So that's very much our focus. I've not actually heard of that particular acronym before, but I will go away and have a look and see if there's anything I can find. I'll share the link with you, Jo.
Lovely, thanks. Marina, are there any other questions?
Yes, we've had quite a lot of questions. So we've had a couple of people asking that they've done some thinking and they've done some market research and business planning, but how do they get the trustees and the rest of the board on board with the idea? And then if they are on board, what do they do next?
I think that's a really good question. It's one of the things we've often come across, that we might talk to a chief exec who says they're really passionate about this and they can see a really good role for social finance, but they're struggling to get their board to get over the idea of the risk that might be involved. Yeah, any tips, Carolyn?
What I would probably tend to do is see whether you could bring in another organisation, a similar organisation that's done something similar and that have been successful in what they're trying to do. So you can use them as a case study that will try and then help your trustees feel maybe empowered or braver to actually make that decision. What we tend to also do is offer to come and talk to boards of trustees, not to try and force them down the decision-making process, but when it comes to loan finance, I think sometimes the chief executives are more comfortable if we actually go and present in person and they meet us, and we can talk about our experiences and we can talk about how we've supported organisations. And I think sometimes that face-to-face meeting for trustees is really, really important. But I think I would try and use case studies.
I was just going to say, Annie, I'll come to you because I guess you guys hold a lot of resources that might be able to play a role in this.
Yeah, absolutely. I completely agree with Carolyn. It's all about hear from a peer stories. I think with this one, kind of hearing from trustees who have been there, done that, and how they got their board on board, as it were. We used to have a program called Get Informed, and that has recently, because it was Trustees Week last week, been kind of migrated over to the Good Finance website. So we have a number of videos, case studies, hear from a peer stories, and additional resources for board members that can just be shared with them in a link in the first instance to help them to kind of get to grips with the process, understand it. So again, I'll make sure that you've got the link for that, Jo, to be circulated after the session. But yeah, I really think it's just about seeing how others have done it previously, and learning from the tactics that worked for them.
Thanks. Linda, anything to add?
Well, I was kind of just thinking, I don't know if this is a bit, I don't know, playing devil's advocate, but actually having trustees on board, you've got to work on those who don't quite get it, but maybe it's also about having some trustees who do. And if you don't have them, what, because you want to, as an organization, work with, have people who've got that perhaps experience in their day job or whatever to have taken on loan finance. But we've worked with plenty of organizations where that's, this is new to them and this is not something they've done before. And as Carolyn says, we're very happy to chat to them directly, and we want to be there to give any kind of reassure and answer any questions that we can.
Just as a little plug for Eastside People, obviously trustee recruitment and also looking at kind of skills on boards is work that we also do, and we're always happy to chat to organisations where they might want that conversation when they're looking at their governance. Great. Marina, I'm looking at the time, so I'm aware we don't want to make sure we've got time for Darren, but is there another question we can pull out that would be good to have today?
Well, I know that Carolyn did mention it, but we've had quite a few questions about interest rates and charges, and so I don't know if it's worth someone sort of summarising. Because we've had several people asking.
Yeah, let's maybe have a very quick summary, because I know it's a bit of a variable anyway, but yeah, just about sort of the overall approach. Maybe Linda, go first.
Yeah, absolutely. So most of our interest rates tend to be in the single digits. We, in terms of our unsecured lending, tends to be around 8.5%, which, I mean, as we discussed earlier, some people will come to us and say, well, that's no cheaper than what I can find, advertised on the high street, which if you can get 8.5% loan as a small social enterprise, I'd be very surprised. So, even if you can see those kind of rates advertised, usually it's, not for your type of organization. But usually within the single digits is what we'd kind of charge, usually on a fixed basis, so that you can kind of really plan and know exactly. Base rate has obviously in the last couple of years changed a little bit, so but then also remember that when it comes to kind of equity and share revenue share type repayments, it'll be quite linked to your performance, which is usually then means it can be a little bit more expensive, because we're taking a bigger risk, where if you're not making a profit, we're not asking for repayment. But equally, when you do kind of ask for repayment, when you do make a profit, we get a repayment, and that tends to be maybe around 10% or more. And just to mention as well that there is an arrangement fee, as I think we mentioned, ours tends to be around 1.5% of the total loan amount. So we have some kind of blended grant and loan products, and usually our arrangement fee is just on the loan part. So yeah.
Thanks. Carolyn, do you want to quickly, maybe one line, summarise your approach and perhaps what the blended bit tends to do for all of those costs as well? It's useful to have that.
Yes, so our margin tend to be somewhere between about 1.2 and about 3.5 above Bank of England base rate, which is currently 4%. What I would say is that the 1.2% margin is for probably the very largest and the very top quality borrowers. So I'm talking about registered providers here, whereas the smaller organisations and perhaps where we're taking commercial security tends to be about the 3.6 mark. Our LEAP loans are probably priced in a similar range to the ones that Linda has mentioned, particularly where we're lending on an unsecured basis. As far as fees are concerned, it's very, very difficult. Our arrangement fee is 1%. Valuer, legal fees, that's really hard to judge. I would say on an average basis, it's probably about 4,000 or 5,000 per loan for both sets of fees, but it really just varies on the nature of the security. And unfortunately, charities often are buying or operating from properties that have very complex titles. So there's often covenants on those properties. Their use may be restricted, and that can add to the legal costs.
Yeah. Thank you. I think it's useful to cover that, because that's always the question: how much is it going to cost me? How long is it going to take? Thanks so much.
To add, Joe, that you can, I think, from the Reach Fund, you can ask for part of your Reach Fund if that's something you're looking for. You can ask for legal costs to be covered as part of that.
Yeah,
And
thank
and
you.
actually that's a good point, and valuation costs as well.
Yeah,
And
yeah,
get a fixed cost, particularly re the legal costs. Ensure that the costs are fixed.
yeah, yeah. No, that's great. I'm just aware of the time a little bit. I was going to ask one question. It probably can be answered in one set in one line. Just can you come back for more? Was the question that I had.
Yes,
Yes.
yes.
Yes,
Lovely.
absolutely.
But you can come, but make sure you've got it right for your initial project. If you say you want to borrow 100,000, then you come back and say we got the numbers wrong, we need 150. That causes concern. If you borrow 100, then want to do another project and want another 100 or 150, that's fine.
Okay, that's brilliant. Thank you. Lovely. I think at this point we'll pause. As I said, we will look at the questions, and if there's things that have come up that we haven't responded to, we'll endeavour to get back to you outside of the session. There is a link to things like the Reach Fund as well on the resources section that are coming out with this afterwards. Okay, Darren, I'd like to introduce you now to talk to us a bit about Own Merit, the journey you've been on to get to that, to Own Merit, and what kind of your investment objectives have been. Thank you.
Hi, everyone. Thank you very much for having me today. A little bit of a background in Own Merit. So, I worked for the Ministry of Justice, whether that's through probation, HMPPS, which is His Majesty's Prisons and Probation Service, and the Ministry of Justice for 18 years. And during that time, the biggest challenge we had was accommodating people post sentence. So, after they had been in prison, or even if they have a community sentence, landlords just see them as too risky for insurance and all the rest. And with the short-hold tenancy agreements, it's too risky a profile of person to accommodate. So there's a big gap in service, but we know housing someone alone reduces their likelihood of reoffending by 50%. So if you do nothing else, house someone, you reduce the risk of reoffending and you make our society safer. So this is something that I've been acutely aware of. Another big issue was that when housing people in supported accommodation, and I'm not sure how many people know this, but the individuals are told, do not work, because the local authorities who pay the housing benefit do not get the rebate if the individual works. And if that individual works, they can often be expected to pay £400 a week towards that missing rent. So they're better off not working. And this is a failed system in our view. So I am also I am a landlord as well. I had a property in Northampton which I was renting out, and then in 2019, I was unfortunately involved in a terror incident on London Bridge at Fishmongers Hall. Um, and what happened there was we tackled a terrorist who was killing people at the event, but I was helped by two prisoners as well as a porter at Fishmongers Hall. Um, a serving prisoner and a former prisoner, and the one of those has become my business partner, Steve Gallant. He got a life sentence, but during his prison sentence, he learned to read and write. He got his business degree, and him and I decided to create a social enterprise called Own Merit. This is a little nod to Jack Merritt and Saskia Jones, who sadly passed that day. But their ethos of about having a more equitable society, a fairer justice system. And for us, a system where we're releasing people into homelessness is not justice. We're making their situations worse. We're not improving them. We're not helping them to change their ways. So we decided to try and address this challenge of supported housing where it puts people at a disadvantage. And we also looked at all the different models of housing, and we found a common thread. Everyone was going for the golden goose or the golden egg of housing benefit, and that's how they were trying to do it. But it wasn't actually helping the individuals. In fact, providers are disincentivized to help people move on and become self-sufficient. Um, so we said, okay, we're going to try and challenge us. And rather than housing people in supported accommodation where you have two staff on site 24 hours a day, which at a minimum cost for a household will be £330,000 a year to accommodate those people. We said, what if you looked at the lower risk individuals and you change the model up and you use technology and you also create a small community where they run it themselves? Probation and other providers said it could never be done. It would become a university of crime. It would be all chaos. You can't have six unknown prisoners together in a household without staff on site. Well, we've done it for 2.5 years now. We've housed 23 men. We've done it on universal credit, and we haven't had a single act of violence in the house. And so many success stories, I can't count them. We've also opened a small gardening business. We've opened a social enterprise cafe and a gym, and we're busy trying to open a little bricklaying training facility because the mainstream providers won't have ex-prisoners in their establishments. Then this brought us to a press release that went out, and Big Issue Investments reached out to us saying, "Look, we love what you're saying here. Let's see if we can help you." And what a blessing that was. So, after meeting up with Angelo in Big Issue at Big Issue, they listened to our model. They were quite inspired by it. That we could do it on universal credit alone is really interesting because we could make this scalable. Also, from our research, we found a lot of great models, but they kept getting closed down when the council turned that tap of housing benefit off for whatever reason. So those models are not sustainable. They're not in the best interest of the council, the local authority, the individual, and the DWP can't get them into work. So it fails, the whole of society fails on that model. There is a place for supported housing, but a lot of those people don't need that much support and need move on progression help. So with Big Issue, they said, okay, well, we will help you. And this was important. They helped us apply for the Reach Fund. And it was a much easier application than some of the funding applications we've ever put in. And then with the Reach Fund, it was reasonably simple. And then we were put in contact with Eastside People, with Joe, and they assigned someone with business acumen, business expertise, and that happened to be Stephen Elsden, and he had experience within the charitable sector and within housing. So it was perfectly matched with what we are looking to do or what we are doing. And through that, it was really helpful to have someone else look at our organizational structure, understand how we're trying to be disruptive, how we're trying to do things very lean. We don't have the benefit of housing benefit and a lot of income on our model. And so he gave us advice on that. And from that advice, we're setting up a CIO. So we are registered as a CIC, but we're now separately setting up a charity that will work alongside. And that helps for a lot of things because because we don't want to just be about handouts, we want to earn income, we want to be a revenue generating social enterprise. But then there's sometimes a difficulty between that and the charitable status. By having those clear lines, it makes it easier to get investment and separate where that charitable money comes in and where some of our more business orientated investment comes in. He helped us model different approaches within our housing, looking at it, seeing if it is scalable, if it is affordable, if we can afford salaries and all the rest that needs to be applied, and running the numbers. From that, it became apparent that although we've got these huge ambitions, it makes it very difficult to scale. And so we had to adjust it a little bit. We've worked very hard within our project in Northampton to bring partners with us because everyone's so used to doing things the way that they've done it. When you bring something new in, they're all like, hang on, we don't know what that is. That doesn't work. And what we've done is we've separated housing benefit from the local authority and universal credit rent. So now what we do is we get the universal credit rent and we get a supplement from the council for the services we provide. It's not supported living, but supportive because the household runs itself. And we fund guys for taking on roles and responsibilities within the house. But it's been a journey of getting other people involved and understanding this new model. And DWP now are huge supporters because they see how it benefits the individuals and they can get them to work. The council love it because their rebate isn't a threat. They pay far less. They're not paying that rent portion. So we're calling the UC Plus model. It's a whole new model, but people are coming alongside with us. And with this now, we've only just started getting some income from the local authority that is paying for that support level, which now makes us scalable, which we only found out we needed this by doing the work with Eastside People from that Reach Fund. So the interesting things, and I think this is what everyone will be questioning, why should we go big issue investments or with charity bank, etc. it's not just about the money. What for us was really important was the conversation. They will look at models that don't fit the norm, something that is different, disruptive, that can challenge that mindset of this is how things work and that's the only approach of doing this. Um, and some big things that were really important for us was the lower deposit amount. So it can be difficult to raise the deposit amounts, especially when you're looking at properties. Properties are expensive. In Northampton, a typical HMO of 5 or 6 bedrooms will cost about £300,000. So even 10% for that is 30 grand without even stamp duty or the fees taken on board. So 10% is much better than the typical 25% that you'd need for a buy-to-let property anyway. So straight away, that makes it a lot easier to access. The other thing that was interesting was that Big Issue Investments were offering us a part grant, part loan. So the benefit of this, even though the rate is, I think, 8.5, they were offering us 20% of that as a grant, and the rest was as a loan in our situation. And then with the arrangement fee, it meant the overall rate was about 8.3%. That may seem high to some, but actually you get so much more for that because of the flexible terms. So understanding what our projects were, it was a bit of hand holding, but also looking at each project and property on its own merit. And so it was a conversation rather than a computer says no. And a lot of people trying to go for financing will find that it's very computer says no. Whereas Angelo and the team sat with us, listened to what we're trying to propose, understood how disruptive our model was, and wanted to help us get there. There's also some things which are really helpful, such as payment holidays if they needed, depending on what your business is requiring. So they're really listening to what you need as a business to provide that social impact. And the money is a tool to help you deliver that rather than a whip or a threat all the time. And it's that conversation if you need to adjust things, which I thought for us was a godsend. Things like early repayments, if you're able to repay that loan back earlier and get cheaper finance, they're saying, please do that. You're delivering good service. We will help you do that, and we're not going to penalize you for that. That is incredible. What bank will do that? They lock you into these terms and say, you're stuck here. This is your term. You have to do that. And if you get out early, you have to pay 2.5%, 3%, whatever, depending on the years. The other thing is Big Issue Investments wanted to make sure that whatever we took on as a loan would be sustainable so that when we're looking to move on to a regular bank or anywhere else, that we've got enough equity to do that. So we've worked down to the 25% so that we've got that enough for that deposit amount for a regular provider. And they wanted to make sure that we could sustain the property. So their thinking is not just short term. They were thinking ahead, saying, okay, where are you trying to get to? How can we help you get there? And it's almost like having a business partner rather than a bank, someone who wants you to achieve what you're wanting to do. So then I move on to some of the challenges. And we've faced quite a few challenges. The macro environment, things we can't really control. Changes to rules and regulations for landlords and housing and all those things, the regulations within the local authority, the licensing fees that are going up for HMOs, all those sorts of things we can't change. Changes within our local authority. We've worked really hard to build and establish relationships. Our closest relationship was with the CEO and the assistant CEO within the council, and both of those have left in the last 6 months. So those are things we can't control, and unfortunately, that slows things down. One of our challenges, the deposit, even at a 10%, which is much easier to achieve, it's still a lot of money to raise, especially when we're trying to do it so leanly and we've been funded on universal credit alone. So those are still things that we struggle to overcome, is that initial deposit, stamp duty, and fees. Loan ceilings. So Big Issue really want to develop a relationship, and in the beginning there's lower loan amounts, and this makes absolute sense. I totally agree with it, and I understand that. However, there's the loan ceiling amount of around 200 grand, and then the house prices in Northampton. We need bigger houses for the economies of scale with our model. And so then the 200 grand isn't quite enough for the cost of our houses. We're looking at around 300 grand. So that's another big preventative factor. So then we need much bigger loans. So those have been the challenges that we've got at the moment, but we're getting a lot of support from people who are seeing how we're being so disruptive. We've shifted slightly because unfortunately, there's not a lot of money that follows prison leavers, but there's more money that follows care leavers and veterans, actually. So we've shifted slightly to look after care leavers from 18 to 25 who've been in contact with the criminal justice system. So that's people, we collect them out of prison or they are on a community sentence. And there's a big gap between 18 and 25 in services. So we found a real niche area, but there is some money that can come in from the Children's Trust. So we're getting a little bit of money. We're trying to save up those deposits, and we're looking forward to purchasing more houses and delivering more of this for care leavers who've had contact with the criminal justice system. So that's a whirlwind, a lot of information. But yeah, I can only say that it's been very beneficial to ourselves, and we're looking forward to progressing.
Thank you so much. That was so useful and interesting. And I think it brings to life in a real sort of case study everything that's been said today by our panelists. And I suppose some of the things that have just occurred to me to sort of highlight are, I think, the importance not just of the social impact, social value, social return that the social finance is set out to place a value on, but it's also actually that it can fund that sort of innovative disruptor type organization as well, and give a chance for people to come with new responses to society's challenges. And I think that's a really important area that social finance can address. I also wanted just to stress something I think that came up earlier, but about, I think Carolyn said around, have the beauty parade. If you're an organization looking for the finance, go and talk to a number of different social investors, social banks, and see what they all offer and weigh up the different sort of approaches that they have. Find somebody where the chemistry is good and also where the terms are right. So it's a conversation on both sides, and finding a good match is the key thing. We've got about 5-6 minutes left, so I think it would be good if we had any more questions, Marina. Maybe people have some questions, particularly for Darren, to hear how his experiences have been. So Marina, have you got any other questions that have come up in the Q&A?
Yeah, we've got okay, well, there's one point from Paul who's saying what Darren's describing is absolutely critical. He's been working in housing for 37 years. Not really a question, but there's a question. It's not so much about the funding. It's more about how does Darren assess the referrals and make a decision who might fit? And how did he fund the purchase and renovations in the end if he didn't get all the money from social investment? So sort of two questions, really.
Yeah, very good question. So the first is, well, we were very disruptive and maybe a bit too disruptive. We went into a prison, HMP 5 Wells in Wellingborough, and for 8 months worked with serving prisoners to create a model that worked for them. So I went in and asked them, who here has been recalled? What were the reasons for that? And I walked through it, and around 80% of the room put up their hands. And you listen to their issues, and it's housing is one of the biggest ones, people being released into homelessness straight away. So then we said, okay, now the cost of supported housing is 330 grand as a minimum to have a house staffed 24/7. How do we overcome this? And we created a model where they are self-sufficient. They run it like a community. And what we did was we allowed the guys who were part of that group to refer men from their wing that they thought would be very good in our household. Absolutely groundbreaking and wonderful. The guys were calling each other from prison saying, how are you getting on? They were being held accountable by their peers. And it was an incredible thing. But unfortunately, prison and probation were saying, wait, hang on. How can you have prisoners referring where or choosing where they live? How can you? And it ruffled some feathers in the beginning. Probation actually got on board with it because they saw the value. But the prison was like, no, we can't have this. Probation are happy, but prison and probation weren't really talking. So our referral system changed, and then we just started taking referrals directly from probation. And this was absolute nightmare. They have their needs and they need to house people. So individual probation officers were just referring people that they wanted and they needed a solution for. We had no way of really testing it, and we had some very chaotic times during that period of time. But now we've built the relationship with the Children's Trust, Northamptonshire Children's Trust. They see the value in this model, and they help us with the referrals of trying to match young people who've been in prison, who want to make a change, who want to change their outcomes and not get sent back to prison. And that's much better because we've got a PA. The care leaver has a personal assistant assigned to them, and we work closely with them. But what's also interesting is we work really well with probation now. So we can be more of the carrot while probation is the stick, and we can offer that support and guidance. But then the probation service can make sure that the boundaries are always set and that people know what's at risk if they don't comply with us. So yeah, that was the referral. So now we get them directly from the Children's Trust. The other one about funding. So I had to put in my own money, if I'm honest. So I used my own property. I made about £25,000 in losses over the first year and a half. But we've slowly managed to pull those back through universal credit alone. There were some little funds. There's a prison leaver fund that certain councils got. We've lost that since, but we could get a little bit of money as a referral. But I've also worked out a relationship with the DWP now where we're much quicker at getting their universal credit payments, so we don't make as many losses. And we've got a few small charitable donations that have made up losses and also helped us build these little organizations. So, for example, the Merit Cafe, it cost us a total of £13,000 to build the cafe. We got a £5,000 business innovation grant from the council. So that meant our overall cost was 8,000, and we now turn over about £2,000 a month in that cafe, and it gives one of the guys some work to do. He cleans it, etc. So yeah, there's different little things that now bring a bit of money in, and yeah, so that's the funding.
Thanks. That's brilliant. Marina, probably one more question, and then I think we will be needing to wrap up.
Yes.
Keep
So
within
this one
time.
came in the last round, but it's quite relevant, I think, to Darren, because this person's saying they're a migrant charity, and they currently rent 2 houses where they place unaccompanied asylum-seeking children, but they're looking at buying 2 houses. And is that a viable thing to do? Because Darren talked about moving away from renting to buying because it was a better investment. So I don't know if Darren and some of the panelists have got a view on that.
Thanks, Marie.
Yeah, go on, Linda.
No, I mean, if you got, I was just going to say, absolutely. I'm sorry, I was so enthusiastic. I just wanted to say, that absolutely, if you've been able to pay rent on this house, or these 2 houses for the last couple of, last few years and demonstrate that, then if loan repayments are less than that, then absolutely. Unless there's something drastic changing in your forecasting over the next few years, then I don't see why you wouldn't do that. Yeah.
Carolyn?
I thought I'd actually answered this one, but maybe I hadn't. I'd answered it online in their question, but yeah, as Linda has said, most definitely, you just need to think about whether you've got any money to put towards it, because most lenders have a maximum loan to value, but that can be overcome if you've got strong debt servicing. I mean, we frequently work with Big Issue Invest. I think Linda touched on it earlier, where we might provide money against a first charge, and Big Issue Invest provide the top-up funding, or we can do that with our LEAP programme as well. So yeah, most definitely, as long as you've got the income to service the loan. And I always say to organisations, if you own your own buildings going forward, if you get into turbulent times, if you've got financial challenges, you've got far more options if you own your own buildings.
Yeah.
Thank you. I think that's a nice, probably positive place to finish. So I just want to thank all of our panelists so much. There was so much information there, and I really appreciate the time you've given this morning. Thanks to everybody for joining us and sticking with us. It's been a long but very informative session, and also just to apologise for the slight technical hiccup. Just showing you here that you will get this pack, and there are some resources and links to things that are useful, and there's also the contact details for all of our panelists, so you can get in touch with us with any questions that you've got. Thanks so much again. And yeah, we look forward to seeing you soon and you getting in touch. Thank you. Thanks so much, panelists.